Hello, this is Peter Wouters, and welcome to the Tax, Retirement, Investment, and Insurance Planning Strategies and Solutions, or TRIIPSS as we call it, webinars. This is the 10th in a series of webinars that we've been providing you for the last couple of years. Today's subject will be the Federal Budget 2019 Overview. The Liberal government tabled its fourth federal budget on March 19, 2019. Finance Minister Morneau presented Investing in the Middle Class, a budget ostensibly focused largely on benefiting middle-class Canadians. The following 7 areas will be covered in today's presentation. 1. Supporting first-time home buyers. 2. Increasing the housing supply through partnerships and targeted investments. 3. Introducing the Canada Training Benefit. 4. Moving forward and implementing a national Pharmacare strategy. 5. 2 senior-focused initiatives, securing retirement benefits of seniors, and 6, introducing a national dementia strategy in addition to support for employment of persons with disabilities. 7, several additional proposals targeted at farming and fishing operations, going green, and medical expenses. These areas cover the parts of Budget 2019 that are of the broadest interest to financial advisors and their clients. So here, in fact, is the overview we'll be going through. Again, if you have any questions, feel free to use those lines and we'll answer as many of them as possible. If we don't get to your question sometime during the session, we'll be sure to get back in touch with you individually afterwards. Business succession planning is a subject I often talk about. The intent may be for a family-owned business to keep the Canadian-controlled private corporation in the family. A consultation paper on the taxation of shareholders in private corporations was developed in 2017. And finance was supposed to review the income tax rules triggering punitive tax results on a share transfer to a family member, in effect thwarting and frustrating the efforts of families to pass on a family business down to succeeding generations. The budget contained no specific proposals dealing with unfair tax results under Section 84.1 of the Income Tax Act of Canada. Now, what does that mean? What is Section 84.1, and how can that be a frustrating and impediment to actually passing a family business on to a succeeding generation? Let's say that a parent wants to sell a business to a child, and the child, who doesn't have the cash, decides to hand the parent a promissory note saying, "I promise to pay you," and under option 1, decides to use taxable dividends from the operating company that the child has now taken over to repay the promissory note personally. In that scenario, under option 1, the parent gets a capital break. Option 1 is quite expensive for the child because of the high tax rates on dividends used to buy the parent share. So let's look at option 2, which is much more cost effective for the child. In this scenario, the child would set up a holding company and use tax-free intercorporate dividends from the operating company that the child wants to purchase to repay the promissory note. So the holdco is in effect buying the shares of the operating company. But in that situation, the parent is deemed to receive taxable dividends and loses the capital gains treatment. Section 84.1 of the Income Tax Act in Canada is an anti-surplus stripping rule that applies when an individual sells shares of one corporation to another non-arm's length corporation, for example, to another corporation owned by the same individual. But in this scenario, the parent is not selling the shares in his or her operating company, or Opco, to their holding company, or holdco. He or she doesn't even own the holding company. Their child does. This is not surplus stripping scheme in the traditional sense, being used by the owner of the operating company. It's a way of passing ownership of the family business to the owner's child so that the child can continue the family business. One issue is that the holding company is owned by someone who is considered by the Income Tax Act as not being at arm's length with the seller. It is a parent selling a business to a child. Under option 2, the parent will have both a deemed dividend for the value received, which is in excess of the adjusted cost base of the business. In essence, they're going to be deemed to have received a dividend for the fair market value of the business over and above what they put into that business, what the business cost when they set it up. So they'll get both a deemed dividend for that and a disposition of the shares being sold to the child for capital gains purposes. However, the proceeds of disposition are reduced from the fair market value to that adjusted cost base, which means there is no capital gain.
Peter, I have a question for you. Is this always the problem?
In fact, it's not the problem. This wouldn't happen if the business was sold to an arm's length party, i.e. someone who wasn't related to the owner. But that's not what we're trying to do here. That's not the intent of a family-owned business. That family-owned business is being disadvantaged by the Income Tax Act and the rules as they stand right now by getting a harsher tax treatment if they sell it to a child than they would if they sold it to a stranger. Again, nothing was covered in the budget, and there has been no report on the 2017 consultation paper. Now let's look at farming, fishing property, and the small business deduction. Farms may rely on other businesses to sell their crops, sell their grains, sell their fish, if you're looking at a farming or fishing operation. Specified corporate income of Canadian-controlled private corporations are disqualified from the small business deduction. So certain types of income doesn't even apply, and that's covered under Section 125(7) of the Income Tax Act of Canada. And that includes certain income earned from the sale by farming and fishing to a co-op corporation with a farm corporation or specified persons has a direct or perhaps even an indirect interest. Currently, there is certain relief given to Canadian-controlled private corporations carrying on a farming or fishing business from the tax rules, which are designed, generally speaking, to prevent the multiplication of the small business deduction. The example I'm considering right now is a farm corporation selling their crop to a granary. If the co-op is claiming the small business deduction, then the limit is normally shared. What the budget proposes to do is to allow full access to the small business deduction for both operations, the farm and the granary, retroactive to tax years after March 21st, 2016. So this issue has been going on for several years right now. It's relieving to see that this proposal will go retroactive to 3 years ago. Budget 2018 proposes to extend that relief to sales of farming products and fishing catches to any arm's length corporation. And again, that measure applies to taxation years that begin after March 21st, 2016. Now let's consider government retirement benefits. And you know, I speak about this subject quite a bit. The number of retirees that we have right now and the growing number of people that are near retirement or about to hit traditional retirement ages. An increasing number of seniors continue to work or go back to work in some capacity, some because they have to, some because they want to. The current guaranteed income supplement threshold doesn't recognize this reality, nor the fact that the thresholds are far too low for low-income Canadians. Not necessarily low-asset Canadians, I'm talking about low-income Canadians. Budget 2019 poses an enlargement of the recipient base and helping working seniors. They're going to do that in a number of ways. The proposal will be enhancing the earnings exemption from July 2020 to the July 2021 benefit year. Self-employed income will be eligible, and up to $15,000 of annual employment and self-employment income may be exempted or subject to a reduced clawback of the guaranteed income supplement. What are we talking about? Well, right now, sorry, let me go back a slide. Right now, what we recognize is that there are 40,000 Canadians eligible for a Canada pension plan not receiving their benefits. They've either applied late or they didn't apply at all. So we've got 40,000 Canadians right now over the age of 70 who aren't getting their Canada pension plan benefits are entitled to do so. Legislation is being amended to automatically enroll contributors to age 70 in 2020 who have not applied for benefits. So if you haven't applied for your Canada pension plan by the age of 70, you will be automatically enrolled in the Canada pension plan at that point in time to deal with the backlog, to deal with situations of people who forgot, who are applying late, or who don't apply at all. By that point in time, this time next year, there'll be an additional 1,500 eligible people turning 70. Now, there is no advantage to postponing benefits past the age of 70, and some people may be under the misassumption that, yes, I can take my benefits as early as age 60. Normal retirement age is 65, and that's when I would get full Canada pension plan benefits, but I could defer my Canada pension plan benefits to as far as age 70. You certainly can't defer it past age 70 and expect to get an increased benefit. There's no advantage to postponing it. As I said, when we're talking about the guaranteed income supplement benefit, we're talking about a guaranteed supplement benefit and allowance enhancement. These are income-tested benefits for low-income seniors resident in Canada. The benefits are non-taxable and they serve as a supplement to old age security. The guaranteed income supplement amounts for an individual receiving full old age security pension as of the first quarter of 2019 are as follows. And here are 4 scenarios of many that I'm going to cover off. We could be dealing with an individual who is single, divorced, or widowed pensioner. The maximum monthly benefit they can expect to get is $893.32, and the maximum annual income threshold is $18,240, at which point in time those benefits would all be clawed back. If we have a scenario where the individual has a spouse or a common law partner who's receiving full old age security benefits, the maximum monthly payment would be reduced to $540.77. But the maximum annual income threshold of combined income increases to $24,096 before that benefit is clawed back. There could be a scenario where there's a spouse or common law partner that's not receiving old age security benefits. In that situation, the maximum monthly payment jumps back up to $898.32. And now when we're looking at combined income before all those benefits are clawed back, we're looking at $43,728. That same threshold, $43,728, is a point in time where you lose all those benefits if you're in a situation where you've got a spouse or common law partner receiving the allowance. And the maximum benefit you'd be getting in that scenario would be $540.77. So that's how it works right now. The Budget 2019 proposal, again, is to enlarge that recipient base and help working seniors by enhancing the earnings exemption, by including self-employment income, and as I said earlier, by having income up to $15,000 of employment or self-employed income exempted or subject to a reduced clawback. Specifically, the proposals are laid out as follows. For each guaranteed income supplement or allowance recipient, as well as their spouse, there will be a full exemption going from $3,500 a year to $5,000 a year. So $5,000 a year of employment or self-employed income will not count towards the clawback of any guaranteed income supplement or allowance. Plus, there may be up to a 50% partial exemption on up to $10,000 of additional annual employment and self-employed income beyond, as I said, that initial $5,000. So $15,000 in total. What does that mean for people? What we're looking at potentially is a 50% higher threshold until guaranteed income supplement benefits are fully clawed back. The annual income threshold going up to $30,000 up from, I said, $20,000. In the example, of course, you know, it's a little over $18,000 today, but we're looking at about a 50% increase once this thing kicks into effect. So a nice, healthy increase. Enhanced tax compliance and addressing aggressive tax planning. Aggressive tax planning has been occurring for many, many years, and we hear in the news all the time about certain types of schemes that are being attacked by the Canada Revenue Agency. And I'm going to share some things with you that are happening right now and how this may impact the work you do and some of the things that your clients are doing today. The Federal Budget 2019 5-year proposal includes an investment of an additional $150 million to address tax evasion and tax avoidance by building data quality examination teams, hiring more auditors, building in technical expertise in the digital economy and cryptocurrency, and enhancing programs targeting offshore non-compliance. On top of that, the budget proposes investing an additional $65 million to improve information technology systems to stay ahead of advanced technology enabling non-compliant schemes. And this really builds on the federal government's earlier initiative. Now, the budget expects revenue generating to come from all of this. In other words, to get a net gain from all these investments. So you look at the $150 million of additional monies being addressed to deal with tax evasion and tax avoidance, and an additional $65 million to improve information technology systems. The federal government assumes that they'll actually be able to make a profit on that, to actually get that money back and make a profit. Critics are saying, you know, the probability of the expenditure if the budget is passed is 100%. But the probability of actually getting revenues, let alone revenues that will completely offset these investments, is subject to question. We'll have to wait and see. So what does this mean for things like tax-free savings accounts and restrictions in that area? Well, the Canada Revenue Agency considers that active trading of securities in a tax-free savings account may trigger taxation in the trust. And that's been covered in various CRA views documents, folios, and tax-free savings account audit projects. If you'd like more information about that and some of the information where I'm getting that from, drop me off an email or talk to your account executive. I'll be glad to send you some information. Now, all of this is despite court rulings to the contrary dealing with registered retirement savings plans. And as you recall, the types of things you can do in terms of investing in a registered retirement savings plan hold up for a tax-free savings account. But the Canada Revenue Agency has initiated some very aggressive audits on taxpayers deemed to be carrying on a business in a tax-free savings account, including active trading. A tax-free savings account is not to be used to carry on a business. Tax-free savings account business income and non-qualifying investments are subject to tax. There is a proposal right now that the existing joint or several liability of the trustee of a plan is going to be capped at the asset value of the tax-free savings account plus any distributed value after the assessment is issued. Currently, the trustee of a tax-free savings account, like a financial institution, is jointly and severally liable with the tax-free savings account for Part 1 tax. The holder of the plan, on the other hand, is not. So what may happen is where there are insufficient assets within the tax-free savings account to pay any resulting tax liability because the plan holder withdrew the assets or transfers them to a different financial institution, then the trustee is on the hook. The trustee now becomes liable to pay the tax owing. Now, does this happen all the time? Well, the trustee isn't always on the hook. This differs from the scenario where the plan holder buys a non-qualified or prohibited investment inside a tax-free savings account. In that case, the plan holder is liable for any tax imposed under Part 11.01 of the Income Tax Act of Canada. I notice another question here dealing with what happens if the tax-free savings account is closed and there's an assessment. Well, the federal budget states that to recognize that a tax-free savings account holder is typically in the best position to know whether the activities of the tax-free savings account constitute carrying on a business, the liability for taxes owing on income from carrying on a business in a tax-free savings account will be extended to the plan holder under a new subsection 146(2)(6.1 of the Income Tax Act of Canada. In that situation, the trustee will not be liable for any tax levied if the notice of assessment deeming a tax-free savings account has been carrying on a business, like active trading, is issued after the tax-free savings account has been closed. So you can't play around by getting involved in active trading and before the CRA blows the whistle on you, take all your earnings, winnings, walk away, and leave the trustee holding the bag. In actual fact, the trustee will not be left holding the bag after the tax-free savings account has been closed. The tax liabilities and the tax levied, if the notice assessment is issued afterwards, will flow through to the plan holder. So the tax-free savings account holder will be jointly and severally liable for tax payable on earned business income. Last year, you heard me speak a number of times about the resurgence of individual pension plans. Well, there are some limitations here because, as with any idea or any old idea, sometimes people kind of push the envelope, bend it, or in some cases, break the spirit of the law. And here's what's really happening in terms of some individual pension plans. First, what is it? An individual pension plan is a one-person registered defined benefit pension plan. Contribution amounts are actuarially determined, and it really operates much like a supersized registered retirement savings plan that requires special actuarial and administrative services for compliance purposes. What are the benefits? Well, a recipient could get an annual pension at age 65 equal to 2% of their indexed T4 earnings, subject to a maximum pension limit. And those benefits would be adjusted for inflation based on the consumer price index. The motivation to establish an individual pension plan are for a number that I can think of right off the bat. It may be to simply increase retirement savings because a person over the age of 50, where the target market is, between age 50 and age 65, could put away as much as 50% more into an individual pension plan compared to what they could put into a registered retirement savings plan. The motivation may be to reduce taxable income in the business through past service contributions. We've heard a lot in the last year and a half about the issues with Canadian-controlled private corporations and retained earnings and how that passive income is really being attacked from a tax perspective. So this may be a way of repositioning that taxable income, otherwise taxable income in the business, by putting it into a bona fide retirement plan through past service contributions in an individual pension plan where it is no longer treated as passive income. A third motivation may be to retain key employees. And the fourth one may simply be to strip excess cash from a company in preparation for a sale or a wind-up of the company. Those are all fairly legitimate reasons for setting up an individual pension plan. For some, though, they've looked at an individual pension plan as an opportunity, if they're terminated as an employee, to form a new company sponsoring a new individual pension plan. That employee then would transfer the full commuted value of the old individual pension plan, or in some cases, a registered pension plan, to a new individual pension plan and avoid the prescribed transfer limit, which is quite a win. How much of a win? Well, the normal rules are as follows. If you're looking at a registered pension plan, the rules permit the transfer of 100% of the commuted value to a successor employer's defined benefit registered pension plan, or a restricted commuted value, the prescribed transfer limit, as I talked about earlier, to a member's individual registered retirement savings plan, which is in the neighborhood of 50 to 55%. The balance of it, if it's prescribed transfer limit, the balance of it is taken into the member's income that year and taxed as ordinary income. And by the scheme people have been doing, of course, is trying to set up an individual pension plan that would accept a full commuted value, not the restricted transfer amount, and skip that, taking any of that money into income. So the proposal in budget 2019 is to exclude in the calculation and the accumulation of an individual pension plan, exclude an IPP from providing benefits for past service or prior years that were covered by defined benefit registered pension plan of a different employer. And that will be effective for pensionable service effective March 19th, 2019. There are some new opportunities for lifetime income from registered retirement savings plans that are slated to take effect in 2020. The first one is the Advanced Life Deferred Annuity, or ALDA, another acronym to the retirement mix. Options for RRSPs, RIFs, DPSPs, PRPPs, and DCRPPs. What are we talking about here? Well, an Advanced Life Deferred Annuity will now become a new retirement opportunity, income opportunity for people that have a registered retirement savings plan, they've got a registered retirement income fund, a deferred profit sharing plan, a pooled retirement pension plan, or a defined contribution registered pension plan. An advanced life deferred annuity will be a qualifying purchase and investment under registered retirement plans. It really, in essence, is a life annuity that begins no later than the end of the year when the annuitant reaches age 85 or would have had she survived. As it stands right now, of course, you know that if you have a registered retirement savings plan, the longest you can defer that money, or the latest you can defer that money, is the end of the year in which you turn age 71. This would, in essence, allow you to take some of those savings and registered retirement savings and defer taking out the income until age 85, or until you would have received age 85 and perhaps you have a surviving spouse or partner. The payments will be equal in nature, must be at least annual, and made to the annuitant. There may be reductions made on the death of the primary annuitant, say to a surviving spouse. There are some more conditions here for the advanced life deferred annuity. First off, on the good side, the value of any money in the advanced life deferred annuity will not be included in the calculation of the minimum amount of withdrawals that you must take from a registered retirement income fund, a pooled retirement pension plan, or a defined contribution registered pension plan. But the lifetime limit for an advanced life deferred annuity will be the lesser of 1, 25% of the property in the registered retirement plan at the end of the previous year, plus amounts used to purchase earlier advanced life deferred annuities, and $150,000 indexed to inflation after 2020. In other words, you cannot have multiple advanced life deferred annuities, each with $150,000. You collect them all, and the collective sum can't be more than $150,000. Much like the overall limit for a registered retirement savings plan, or the overall limit for contributions to a tax-free savings account. So these caps essentially max out the amount of money that you can look at in deferring a portion of to $600,000. So once you get to $600,000 in total registered retirement savings plans, you can take a quarter of that, which is number one, 25% of the property, up to $150,000, and place that into an advanced life deferred annuity. The balance of course, you'll have to deal with in conventional manners. Any excess amounts that you put into the advanced life deferred annuity will be subject to a 1% tax per month for duration on the excess, much like a tax-free savings account. Now, that may be waived due to reasonable error, and if the excess is returned to the registered retirement plan by the end of the year, following year when the excess is purchased. So if I were to purchase that plan this year and I put in too much, the penalties may be waived as long as I put that money back by the end of next year. Secondly, we have a variable payment life annuity, or a VPLA. The variable payment life annuity is really geared towards grouped plans. They're permitted for pooled retirement pension plans and deferred contribution retirement registered pension plans, so company plans. The limitation is that you need a minimum of 10 participating retired employees. Payments are to begin by the end of the year when the variable payment life annuity is acquired and the member turns age 71. Administrators of these pooled retirement pension plans or deferred contribution pension plans are permitted to set up a separate annuities fund under the plan. And in essence, what happens now is that members do not have to transfer the proceeds of the pooled retirement pension plan or the defined contribution pension plan to an individual RRSP and then a locked-in plan or locked-in RIF. They can actually keep it in the plan at the company. The annuity payments will vary, of course, with investment performance of the underlying annuity fund and the mortality experience of the annuitant. So this will be a pooled mortality based on the number of people in the plan. There'll be no direct employer or employee contributions to this plan. All this money will come from the pooled retirement pension plan or deferred contribution pension plan. There will be survivor rights available. There'll be a taxation of the balance on death. And of course, there can be guaranteed benefits on death similar to regular registered annuities. A consultation on both these plans and these potential changes will need to be made to the federal pension standards legislation, to individual provincial pension benefits standards legislation, and draft legislation will actually follow from that. We've got a little bit of time to wait for that. It won't come until 2020, and there'll be more news coming on how this actually will play out in the coming months. Stay tuned for that, where I may either write an article or include it in an upcoming webinar. The home buyers plan. Again, we've heard a lot of the news about the difficulty that people are having getting into the home ownership market. Prices very, very high, not being able to get much of a down payment, the qualifications for getting a mortgage. So the federal budget 2019 is proposing some enhancements. Now, the home buyers plan allows first-time home buyers to borrow from their registered retirement savings plan for the down payment tax-free. Now, the need to repay or replace that money over 15 years, and repayments are to begin in the second year after the year of withdrawal. There's no interest charge for doing this sort of thing. Whatever you take out, you simply got to put back systematically. Now, the current cap per person is $25,000. That will be increasing to $35,000. So $35,000 per person, or if you're in a couple, $70,000 can be used from your collective registered retirement savings plans can be used to provide a down payment for the purchase of a new home. And that includes buying a more accessible home for a person eligible for the disability tax credit. Now, this is all supposed to be effective March 19th, 2019. CMHC will administer a shared equity mortgage. And this is to deal with part 2 of this enhancement to make it easier for people to buy homes by including a new first-time home buyer incentive. Now, this is a shared equity mortgage, which will be up to 10% for new builds and 5% for resales. In other words, the government will take over will have a 10% equity stake in a new construction and 5% for resales. Now, the larger incentive on new builds is to encourage construction of new homes and the purchase of those homes, as well as condos, and support creativity in addressing the housing supply challenge. Now, there'll be no monthly mortgage payments on that equity portion owned by the government, no interest charge that we don't know of so far, and typically it is to be repayable no later than the sale of the home, and we can imagine that in most situations, if it looks attractive, that equity portion owned by the government will not be repaid until the home is actually sold.
Peter, I have a question in for you. What about the stress test to qualify for a mortgage?
Well, under this program, mortgage applicants still need to qualify under the federal stress test. The incentive could lower the bar for applicants since they now would need to qualify for a lower mortgage.
And there's more questions about how the plan works, how it's calculated, the repayment, the risk.
Okay, well, mortgage payments would be calculated on the balance owing after deducting the down payment and the equity mortgage percentage. So the cap-in part is based on household annual income. The higher the income, the bigger the mortgage. So we look at a house, let's say it's worth $400,000. If it is a brand new build, the equity share that is administered by CMHC would be $40,000. That's 10% of the value of the home. An individual could put down 5% on that home, which is the minimum down payment you have to put on that home. On a $400,000 home, that would be about $20,000. So now you're sitting there with a $400,000 home, a 10% equity stake being taken by the government, administered by CMHC. That reduces it to $360,000. You put in a down payment of 5%, that's $20,000. So now you're looking at a $340,000 mortgage. Instead of, say, a $395,000 mortgage, it's now a $340,000 mortgage. But they say the devil is really in the details. The new incentive would only be available for a CMHC insured mortgages. So it's for people that can at least come up with a 5%, but people that can't afford or don't put in more than 20%. You can't put in 20% of the money because CMHC insured mortgages are between that 5 and less than 20 range. But there are some key questions, and they include the following. How will household income be calculated? Will it be the most recent year, an average of some sort? You know, if the cap is to households earning $120,000, if a household earns $120,001, would they automatically be disqualified from participating because of $1? Now, the plan is supposed to be interest-free, but will there be any setup or maintenance charges? What happens if the equity stake is not repaid until the home is sold? Now, presumably, a shared equity mortgage means that if the house goes up in value over time, the equity portion owned by the government will be worth more in dollars. For example, a 10% equity stake would mean that if a home went from $100,000 to $200,000, the government share on the sale would now be worth $20,000. A 10% stake on $200,000 is now $20,000. And you'd have to repay that from the proceeds of the home, the higher $20,000. Now, what happens if the home goes down in value? Would the repayment be based on the value of the equity stake at that time, or would it be based on the original purchase price? If it is based on the house value at the time of sale, then taxpayers would eat the loss, but the householder would win. So stay tuned for updates and details about the first-time homebuyer incentive, which will be released by CMHC later on this year. But here are a few more conditions for the incentive. A minimum down payment for the insured mortgage is needed. And that minimum, of course, still stands at 5%. Household income needs to be less than $120,000. The amount of the incentive plus the insured mortgage together will be capped at 4 times annual household income, and a targeting effective date of September 2019. I see another question coming in here. Question is, can you give us an idea of the price of a home where this would work? Well, in doing the math on it, a number of people come up with the same range. The budget proposal calculates really that the price ceiling up for a home would range somewhere between $505,000 and $600,000, depending on how much a first-time home buyer deposited as a down payment. And of course, the price of the home would go down with household income because the cap is 4 times $120,000. So the most you can get as the equity mortgage and the mortgage itself would be 4 times that, or $480,000. If it's a household that has $100,000, the cap on the mortgage and the incentive combined would be $400,000. So it is geared to I'm going to call it an average price range out of the major metropolitan areas. Not everyone who buys a home as a couple stays together. We deal with separation, divorce, and what I term uncoupling. 38% of marriages end in divorce. That includes common law relationships and same-sex relationships. 9% of Canadians over the age of 15 are divorced or separated and not living common law. In fact, the greatest number of households by category in Canada right now, and the fastest growing, are single-person households, people living by themselves in a condo, in a townhouse, or in a home. The federal budget 2019 wants to recognize the challenges that exist when a couple uncouples, so that persons who purchase a home and once they're living apart may be able to access the home buyer's plan even though they're technically not a first-time buyer. There are going to be certain conditions attached to that, and this is planned to be effective in 2019. Now, the conditions for the home buyer's withdrawal are as follows. The couple must be living separate and apart for at least 90 days due to a relationship breakdown. The withdrawal may be made in that same year, or if they have been living apart in any of the preceding 4 years. So people that have find themselves single sometime in the last 4 years will be able to take advantage of this plan. It's not just for people who newly find themselves on their own. There's going to be a need to dispose of the previous principal residence no later than 2 years after the end of the year in which the withdrawal is made, which may be waived if the individual is buying up the share of the residence owned by the former spouse. So someone is actually going to stay in the house they own together. There are also going to be some other waivers. There's going to be a waiver of the requirement that the home may not be acquired more than 30 days before withdrawal. That's the typical restriction for the home buyers program. That will be waived. In addition to that, the ineligibility, if you or your spouse owned a principal residence in any of the 5 years, a typical rule you're seeing for the home buyers plan will also be waived up to and including the current calendar year. Some other things you need to keep in mind. You may not be able to withdraw funds from a registered retirement savings plan if they are in a locked-in retirement account or an employer's group registered retirement savings plan, because you may not have the right to make a withdrawal under the home buyers plan if the registered retirement savings plan did not already give you a right to make that withdrawal. You also need to watch for any fees and surrender charges, as well as any market value adjustments. Prospective home buyers still need to complete Form T1036, which attests that you have entered into a written agreement to buy a specific home, address included, and repayments are due in a particular year anytime up to 60 days after that year. So much like you can make a deposit to a registered retirement savings plan up to 60 days past the calendar year, you're going to be able to do the same thing on a repayment of the home buyer's withdrawal. You can repay the money into a registered retirement savings plan up to 60 days after the calendar year and stay within the rules and regulations of making those systematic repayments once the repayment period begins. Improved access to education. It's not unusual to have listeners in the group, family members, friends, clients, going through right sizing, downsizing, outsizing, other sizing, working with companies that are no longer in business, and find they need to be retrained to do some other work because they may be too early, too young, too early, not ready to actually retire. So the government is now looking at improving access to education for all people. Let's start off and look at what they're going to be doing for young adults. The Canada Student Loan Interest is terms and conditions are going to be adjusted according to the 2019 proposals. First off, we should be seeing a reduction in the floating interest rate from prime plus 2.5% to prime. So that's a reduction of 2.5% interest on that amount of loan subject to a floating interest rate. If the loan is subject to a fixed interest rate, the reduction will be 3%. It'll go from prime plus 5% to prime plus 2%. So again, a fairly significant drop. In addition to these 2 points, the proposals will be adding a 6-month interest-free non-repayment grace period. To make education more accessible, the Canada Student Grant Cap is being increased from $8,000 to $20,000 per year, and it will be extended to cover services and equipment for students with permanent disabilities. New to the budget and new to Canadians will be this refundable Canada training credit. Well, who's available and who's eligible? Individuals aged 25 or more and who are less than age 65 at year end. In other words, these are people who are no older than 64 at the end of the year, who are residents of Canada throughout the year. You must file a tax return for the year. You must have earnings of at least $10,000, and there's a cap on it as well. Individual net income cannot be greater than the top of the third bracket for the year. That's the way the regulations are being drafted. In actual fact, if you looked at what those numbers would be for 2019, we're looking at $147,667. So people who have earnings between $10,000 and $147,667 and need some retraining are going to be eligible for a refundable Canada training credit. How does it work? Well, eligible individuals will accumulate $250 per year into a notional account. The overall lifetime limit will be $5,000. That notional account balance is based on the amounts accumulated or used in previous years, so you can't refill it. They'll keep track of that $5,000 overall limit. It is a refundable credit, which means it's always worth what it says, even applies if you're not paying any tax. Individuals will be able to claim the lesser of 1, 50% of the eligible tuition and fees paid to an eligible Canadian institution, and the lesser of that, and notional account balance for the taxation year. So again, this non-taxable benefit can be used to help fund training at colleges, universities, and eligible institutions that provide occupational skills training beginning in 2020. Eligible Canadians would claim this benefit as a refund on their tax returns. Now, this Canada training benefit is being paired with the proposed EI training support benefit, so an employment insurance support benefit. That latter benefit will provide 4 weeks of income support set at 55% of the average weekly earnings every 4 years. Small businesses in Canada will benefit from an EI small business premium rebate starting in 2020 to offset the costs of employees taking advantage of this benefit. So this really is a 1-2 punch. The budget proposes a new personal tax credit for digital subscriptions. Here's how it works. It will be a temporary, non-refundable personal tax credit for eligible new digital subscriptions. 15% of the amounts paid will be the amount of the credit. There will be a $500 cap, and it'll apply to digital subscriptions offered by qualified Canadian journalism organization, effective for amounts paid after 2019, ending in 2024. Medical support enhancements. An advisory council on the implementation of national Pharmacare was created pursuant to the 2018 federal budget. An initial report was released in March of 2019. The government intends to move forward on the 3 foundational parts of the report, and here they are. 1, a national Pharmacare strategy. Part 1 is to create a new national Canadian drug agency to take a coordinated approach to assess both the effectiveness of provincial and territorial successes, and to the extent they are successes, to try and replicate that across the country, and to negotiate prescription drug prices for Canadians in bulk, to take advantage of bulk buying power to reduce the overall cost of prescription drugs. 2, set up a Canadian drug agency that will assist in the development of a national formulary, to set up a comprehensive evidence-based list of prescribed drugs, to provide a basis for a consistent approach to formulary listing and cross-country patient access. And again, this will be done in partnership with provinces, territories, and other stakeholders. Number 3 is to set up a national strategy for high-cost drugs for rare diseases, to improve the access to effective treatments for Canadians, and co-develop plans for patients with rare diseases to provide improved and more consistent coverage for life-prolonging treatments. A national dementia strategy will be released in the spring of 2019. The budget is proposing a $50 million allocation over 5 years to support the national dementia strategy. There presently are, in fact, there were as of 2013-2014, over 400,000 Canadian seniors living with dementia. 2/3 of them were women. The numbers are expected to double in 15 years. The National Dementia Strategy is aimed to improve the lives of people with dementia and their caregivers, in other words, the families, and to improve public awareness of the challenges with progressive brain disorders. Let's look at some of the medical enhancements on a more granular level. And the first one is the medical expense credit. This is a 15% federal non-refundable tax credit, and there may be provincial non-refundable tax credits tagged on top of that. Eligible expenses in excess of 3% of net income, or $2,302 in 2018, are eligible for that 15% federal non-refundable tax credit. The proposal is that expenses for medical use cannabis from October 17th, 2018 onwards will be eligible expenses to go towards the eligible expenses for medical expenses, either to drive the number up to the threshold level, or if you're already spending more than 3% of net income, to have those expenses covered by the 15% federal non-refundable tax credit. The second area is an improvement to the registered disability savings plans. Now, currently, there is a limitation during which a registered disability savings plan can continue and the beneficiary isn't eligible for the disability tax credit. So as it stands right now, there is a link between being eligible for the registered disability savings program and being eligible for the disability tax credit. And the limitation during which a recipient is not eligible for the disability tax credit and still maintain that registered disability savings program and not be subject to any wind downs or chargebacks or whatever is 4 years. The budget proposes a removal of that time limitation. And on top of that, to alleviate the requirement for medical certification that the beneficiary is likely to become eligible for disability tax credits sometime in the future. So if a registered disability savings program has been set up for someone who is eligible for the disability tax credit, and at some point in time they are no longer eligible for that tax credit, then first off, there is no requirement that they ever would be eligible for the disability tax credit again. And there is not going to be a time limitation during which that plan can continue during that traditional ineligibility period. You're also going to see a modification of the rules on the repayment of government benefits into a registered disability savings program to be based on the beneficiary's age. So to the extent that there has to be a repayment of these programs, it'll be based on the beneficiary's age. All of this will be slated for 2020. Finally, let's look at the temporary enhanced capital cost allowance, which will be effective March 19th, 2019. The temporary enhanced capital cost allowance will be up to 3 times the normal applicable first-year capital cost allowance on all property. In other words, an accelerated investment incentive. Up to 100% deduction will be available for specific capital cost allowance classes, manufacturing and processing, and clean energy equipment. 100% first-year capital cost allowance for new zero-emission vehicles. There will be a $55,000 plus sales cap on the amount that will be deductible for capital cost allowance on a couple of new classes for vehicles. The balance of it, if you buy a vehicle that's more than $55,000, will be deducted on a declining balance at the 30% rate. And the limit, of course, is going to be reviewed on an annual basis.
Peter, I have a question for you. Are there any details on what kinds of vehicles qualify?
Yeah, it's a good question. An eligible motor vehicle must either be fully electric, a plug-in hybrid with a battery capacity of at least 15 kilowatts, or fully powered by hydrogen. On top of that, that eligible vehicle may not have been used or acquired for use for any purpose before it is acquired by the taxpayer. In other words, they really want to emphasize that only new vehicles will qualify. The new proposed deduction limit, again, is going to be increased from $30,000 plus applicable taxes to $55,000 plus applicable sales taxes. And Budget 2019 will also include a new federal incentive program for individual purchasers of electric battery cars or hydrogen fuel cell vehicles that have a manufacturer's retail price of less than $45,000. And that incentive will be up to $5,000. There are more details to follow. Stay tuned, and it will follow a later date. Again, I will either write an article or a blog on that, or it will be included in a subsequent webinar. To review, I've covered off the following 7 areas in this presentation. 1, several additional proposals targeted at going green, medical expenses, and farming and fishing operations. 2, 2 senior-focused initiatives, securing retirement benefits of seniors, like the Guaranteed Income Supplement, the auto-enrollment of Canada Pension Plan benefits, looking at these new 2 forms of annuities. 3, introducing a national dementia strategy in addition to support for employment of persons with disabilities. 4, moving forward on implementing a national Pharmacare strategy. 5, introducing the Canada Training Benefit. 6, supporting first-time home buyers. And 7, as part of that, and you'll hear more about this in the coming weeks, increasing the housing supply through partnerships and targeted investments. And again, these areas, in our estimation, cover the parts of the budget 2019 that are the broadest interest to financial advisors and their clients. As always, we welcome your questions, your comments, your feedback. If you're interested in hearing about this again, this session is being taped. You can access it on the Empire website. There's a dedicated site where you can access all 10 of the TRIIPSS webinars. If you have an associate or someone else that would like to take advantage of this program and perhaps pick up some continuing education credits, tell them to call up Empire, dial us up, and access the TRIIPSS webinars, listen to them, answer the quizzes, and secure your continuing education credits. Thank you very much for listening, and thanks a lot for your ongoing support of Empire Life and Empire Life Investments.